Okay, welcome back. So we've got the market, which is down about 242 points. It's been down 240, 270, 280. It pulls back a little bit and then sort of starts to sell off once again as things stand right now. Look at Bandhan Bank. I think it's it's breaking down a little bit. 198 on Bandhan Bank now. I'm looking at the April futures contract, but probably I think the cash price will also reflect what we are seeing there. ICRA Bank is down about 6.5% now, 335. HDFC Bank on the other hand actually is outperforming at about 928. It's kind of holding on at this stage. So that's broadly what is happening. Of course, the one area which is still holding on very, very well is the entire pharmaceutical space, with auto leading with those 17-18% kind of gains. We have Subrata Ray, Senior Vice President and Co-Head Corporate Sector Ratings at ICRA, now joining us to talk to us about what the impact of this lockdown will mean on companies and the universe under ICRA's coverage. Subrata, thanks very much for your time. Good to have you here. Let's get straight to the findings of your report, Subrata. Where exactly are we going to see the maximum stress? We know, the sectors where the pain is, we all know very well. The ones which are directly sort of affected, airlines, etc., for example. But what else can you tell us in terms of insights from the work that you've done?
Yeah, see, what's happening under COVID-19 and related lockdown is quite unprecedented. In fact, I don't think the corporate sector has faced anything like this in the last 25 to 30 years. So if you look at the month of March, April, and depending on how far the lockdown is extended, the impact would be severe on many segments, particularly the segments which do not get covered under essential services. The revenue loss could be in excess of 50 to 60% in many cases. In some cases, the revenue loss could be as severe as 90 to 100%. So what we are looking at ICRA is that we have bucketed the various sectors under three categories. One segment which is the highest vulnerability to this lockdown. The other segment is the medium category to the vulnerability to the lockdown, and then there is a low category. If you look at high and medium categories, the typical sectors, as you already mentioned, are aviation, hotels, automobile dealerships, gems and jewelry, retail business, microfinance, shipping, port and port services. In the medium vulnerable segment, we find automobiles, auto components, residential real estate, building material, consumer durables, ferrous metals, and logistics. In the low vulnerability segment, primarily are the more of essential service categories, which are FMCG, healthcare, utilities, telecom, sugar, tea and coffee, food and food products, insurance, or education business. So overall, across the board, most sectors are likely to be impacted quite severely. So we are looking at the liquidity position for the next 3 to 6 months for each entities individually and trying to have an assessment of their credit profile.
Let's now dig a little deeper, Subrata. So that's broadly the three categories. But within the most impacted category, do you think that, have you looked at that most impacted category deeper? And can you tell us, are there instances where companies would go belly up, would not be able to survive? What is the default risk is what I'm trying to understand here from the most impacted category.
See, as I mentioned already that once you identify the vulnerable category, you also have to dig deep into see at individual entities, how they are placed. So the first step we are looking at is looking at the liquidity that is available with the entities for the next 3 months and then next 6 months. The debt moratorium offered by RBI for the next 2 months is definitely a positive. We need to see whether it gets extended further. That apart, we also need to see the liquidity that the company has to pay its statutory dues and also to service market instruments. So overall, entities which have adequate liquidity for next 3 to 6 months, their credit profile may not be impacted immediately. However, there are entities which are under more stress. They could be already under a certain amount of leverage. So in those entities, we need to look further and maybe some rating action would be warranted.
Okay. That's an important point to have in mind. Subrata, if we talk about what you just said, that entities which can at least manage their cash flows for 3 to 6 months, perhaps run the least risk of getting downgraded, their debt downgraded. Which are the broad categories which are in high risk, where you immediately are expecting working capital stress to build in, despite all the measures that we've seen from the Reserve Bank of India on MSMEs, NBFCs, etc.?
If we mention some of the broad categories, obviously hotels, automobiles, and some segment of the residential real estate could come under stress, simply because, again, we have to look at individual entities on a case-by-case basis. However, many of these entities may have a significant loss of revenue for 3 to 6 months. For example, if you look at the hotel industry, even if the lockdown ends today, we don't know when the normalcy will return. So to that extent, the occupancy level and even the error that lockdown ends today, we don't know when the normalcy will return. So to that extent, the occupancy level and even the error that it can command can remain low for a very significant period of time. So definitely this segment, most players would require significant amount of liquidity to tide over the next the coming downturn. So similarly, some of the entities in automobile segment could face pressure, particularly the entities which are in tier 2, tier 3 segment. So those entities, working capital cycle are already stressed, and depending on the amount of credit availability, some of the entities could come under severe stress.
Okay, so you mentioned hotels, obviously, the residential segment. And I also want to get to know your take on NBFCs. I was reading a separate note that you guys also put out projecting higher NPAs for housing finance companies, for instance. So within the NBFC space, given that so many measures have been announced, I mean, now there's this TLTRO2, etc., a lot of push on opening up the financing pipe. Do you think it's going to help? Or are we running the risk of perhaps debt downgrades within the financial sector?
I think as ICRA, broadly, we are evaluating all segments, including the corporate sector and also the NBFC, and taking suitable action wherever necessary. And I'm sure the steps that has been taken already by RBI have been positive in that direction. However, I don't look at the NBFC sector specifically, so I would not be able to comment further on that.
All right, Subrata, thank you very much. Appreciate you joining in and running us through what you make of the default risk as far as India Inc. is concerned from the work that you've done. Appreciate it. Well, the market